Okay, actually, I think these tapes are going to be more valuable than you think. I've had intermediate students tell me, oh, yeah, I'm using those, man. This is fantastic. You actually want to listen to them twice. And they laugh and say, no, I know the crap. You know. And then I've got people in the executive MBA who are thanking me profusely for giving them the ones from intermediate accounting. Like, oh, yeah, wow. Because I've got three hours with the executive MBA students to do about 30 hours worth of material. You gotta see how fast I can talk. I'm talking slowly. You gotta see how fast I can. They're just, whoa. Yeah, but they're all executives, right? And they have successful careers. They just don't know a debit from credit. And of course, so you know it, you don't know it, right? But they can learn fast. And a lot of you guys think you can learn fast. You have to in here, don't you? Right? Those of you who are new, and some of you have been around here a while and haven't been working yet. Right? That's okay. It's cool. It doesn't matter when you start working. It really doesn't. Nobody cares. We have a whole lot of students who come back, mostly guys. It is. Guys come to college, have a really good time, screw around, drink, have a blast. Describe anybody? Yeah, anyway, have a really good time for a couple of years. Practically flunk out. Maybe do flunk out, right? I'm not even describing some of you guys are doing right now. And, it's all right. It's mostly guys. And then some women do it too. And so then they come back when they're 30. I'm not kidding. And they got married, right? And they have responsibilities. There's one back there. Okay, anyway. Anyway, what do you get? 5 kids? Yeah, he's got to work. Okay, anyway, you have responsibilities and you settle down. I want a career, right? And they come back and they take coursework and then we have something called the accounting certificate. You have a degree, you didn't really learn much, undergrad. And then you can come back and you can do a 1.5 to 2 years of coursework. You can take the CPA exam, and you can start your career. Oh, you can be 22 making $50,000 a year, or you can be 30 making $22,000 a year. Wait a minute, what did I say you'd be making by the time you were 32? If you're 22 starting out? 2 to 300. 5 to versus 50. Yeah, but have a good time, guys. And it's really all right. I had a couple of kids come into my office. It was kind of sad. One kid had lost his father when he was in 8th grade or freshman year or something, and they were best friends. So the other dad sort of quasi-adopted them, for advice and everything. So they were telling me the advice their father, right, this fellow, had given. He says, I want you to go to college, and I want you to have a really, really good time, but not too good a time. I want you to be serious, I want you to get good grades, I want you to be set up, right, with a good job when you get done. And then the rest of your life, you can have fun. Versus you go to school and you have just a blast for 4 years and then be miserable for the rest of your life. Because you don't get to do anything fun and you don't get any money. Both. How many of you would rather tell yourself what to do than have somebody else tell you what to do? How many are enjoying me telling you what to do every day also? Nobody, right? How many would like to decide what they're going to do every day for themselves instead? Get a good education. The horrible thing is, then they're going to have other people working for you. You're going to have to decide what they're going to do too, and that's really annoying. I wish everybody just decided for themselves, right? If I could trust you guys, I can't. I could have just given you the book and said, come to class when you feel like it. Work whatever problems you feel like. We don't need any tests because you're just going to learn it because you want to learn it, right? If I were not giving you quizzes, tests, and a final, would you be learning as much as you are now? No. Got to change that. Because when you're the boss, what's going to happen? You're going to decide how much you do and how much everybody else does. Right? And you're going to teach everybody else how to do it. And scramble to learn however you can for the rest of your life stuff you don't. Right? That's work. And it's a lot of fun. Right? And plus it pays. Who cares? You know why I don't care about the money? I have plenty to eat. I can afford my next beer. I'm good. I'll never be hungry as long as I live. I'm happy. So are you guys in that situation yet? Everything's good? Okay. Work. How come I'm working hard with you guys this summer? I'm kind of working hard. You notice that? I give 3 hours. Well, I work hard this summer. The work certainly is class. What kind of money I get. Why do I do it? Because I give a damn whether or not you know this stuff. That's it. I'm a professional. Being a professional is taking care of the people who are counting on you. You don't know you're counting on me, do you? But you are. You need this stuff. That's why we're doing it. Okay? So, we've broken the whole thing of, oh, I'm just going to get 3 credits and get it over with. I don't know. The folks who are in this class that are getting 3 credits to get it over with are getting D's and F's. The folks who are working are doing better. And that's a cross-sell. I'm sorry. Yeah, there are easy classes here. There are. Some of you are taking them. Right? There are easy classes here, but most of them, most of them are just god-awful. Who's been around here for a while? Am I telling the truth? A lot of tough classes. Not easy for her. You've got some easy ones. Depends on the professor. Yeah, it makes a huge difference.
I had easy classes that were horrible because of the professor.
It was too easy?
No, it was supposed to be an easy class.
Oh, and they made it tough.
No, they didn't make it tough. They were just
they were awful. Yeah, well, that could be it. Are you describing my class? Never mind. You don't have to answer that. We put that on tape, too. So I won't make you put it on tape. Okay. Well, let's do this stuff. What do we need to know? Every time I talk to you, you just shake my confidence. It's just terrible. All right, anyway. What do we need to know about investing in other companies? You know, one company issues their stock, another company buys it, right? That's what we're talking about here. Or a company issues bonds, another company buys it. Individuals buy stock too, of course. Individuals buy bonds too, but companies are really the bulk of it. Big amount of it. Okay. So how do you account for them? So just think about this. When a company issues stock, that's their equity, right? When a company issues bonds, that's bonds payable, non-current liability. Okay. When a company buys them, what is it to them? A what? Asset, liability, equity, revenue, expense. Asset. They're assets. And all we're going to do is we're going to have different names for them. Now we have current assets and non-current assets, don't we? Current assets are what? I'm going to hold the asset for how long? Less than a year. Right? What's a non-current one? Longer than a year. And that's going to drive the accounting on all this stuff, okay? You guys already know how to do one of these investments. Investments in held to maturity bonds, right? That's if I buy the bond and I expect to hold it the whole time, right? You already know how to do that, okay? And a lot of you are pretty good at it. I had to do it on the quiz, didn't I? Oh, you got your quiz. You guys didn't finish that. I actually rated it, didn't I? 29.5 is the high. Oh my gosh. Whoever that is, we hate it. Okay, anyway, no, we don't hate it. There are others. Okay, anyway, low, I won't even say it. Mean 15.5. Okay? So, Thomas, that's. It is not good. Very Blakeney is. Hunter is. Cicely is. Didn't have a last name anymore. Emily. James. Harley. Over there. Catherine. Ben Hartman. Sam. Chris. And Miranda. Jared. There. Anthony. Anthony doesn't. Okay. All right. Chris. Casey. There. Jasmine. Right. AC. Everybody? These were good. A lot of them were really good. And this was not an easy quiz. Not easy. By the way, if you didn't get that problem on the back, it's 15 points, and you're partway there, and you got 9 or you got 8. You got 9 or 8 on that, you're in pretty good shape. Study it, study it, study it. You're going to nail it for the test, you're going to nail it for the final. Maybe 30 points, right? Are the ones that are left. How to do this. Same sort of work. You don't know how to do something, you learn how to do it, and then you can do it. Right? So now you're done. Oh, by the way, as soon as you know how to do it, guess what they have you do? That's what's really cool in C papers. Any job, high pressure, high reward, high pressure, high risk. Anyway, any of those jobs. As soon as you know how to do something, guess what you do? You start teaching somebody else how to do it. That's how you move up. As soon as you know how to do that, guess what you do? Somebody else takes that over and you move up. So you're constantly, what's really fun in life, I love this too. You're constantly doing things you don't know how to do. Get used to that. It's fun. Challenging. Don't you feel that way now? As soon as you master something, I've moved on to something else. Even before, huh? That's really cool. That's fun. That's what you want. Well, honestly, that's what you want. But that's at least the personality types we're looking for. Okay, guys, so we got current and non-current, okay? We have investments in stocks and investments in bonds. All right, so what are the categories that we had in this chapter of stock investments? What do we call them? What are the current ones? The current asset type. I better have a smaller line than that. So, yeah, what are they? Marketable securities is the whole group of current ones. Excellent. The current assets are called marketable securities, okay? Because they're marketable real soon, okay? That's good. So underneath the current assets, marketable securities, what are the categories? What do we got? What if I'm going to, now this is going to be based on, if it's stock, it's going to be based on how long we hold it, okay? So there's 3 categories of how long we might hold stock. 2 of them are current assets. What are they? Did you read about it? Well, passive is where I'm just investing for future returns and dividends, and that is going to fit this group, okay? But that's current and long-term both, okay? I'm talking about the account, and then there's active where I have a big enough investment that I'm probably going to run the company, okay? And all those would be non-current, by the way. So that's where my ownership share is big enough I help to run it, or maybe totally run it if I have enough, okay? So yeah, active and passive matters too. Okay, but within the account names, how you would classify things within the current assets for marketable securities, what are they? Just seeing if anybody has really read this and thought about it. What are you guys, getting burned out or something? Of course, right? You got way too much to do, don't you? Keep doing it. Let's go. How much time do we have left? When's the next test? It's the Monday after next, right? And there's a quiz before that. And then we're going to start getting ready for the final, right? And we have a few days to get ready for the final, and we take Monday test, final Thursday. Oh my gosh. This is horrible, isn't it? Okay, yeah, it's 2 weeks from now. So come on. Don't take any breaks. Okay, anyway, marketable securities, what's the deal? One is trading securities. Do you sound familiar if you read it? Yes. Trading securities. Another one is available for sale. Short term. Guess what? Those are the current ones. Okay? And then under the non-current assets, the long-term assets, we call it investments now. This would be an investments category. In here, we would have available for sale long term. Start with these, okay? Start with these. Okay. What makes something a trading security available for sale, short term available for sale, long term? Okay, the first thing is all of these I do not have significant influence or control in the company. What portion of the company do I own? This is the active versus passive things. What portion do I own where I have no Less than 20. What we say is if I own less than 20%, when the shareholders vote, I can vote, but I lose. Right? I don't run the company, somebody else does. Got it? That's the idea. So anywhere from 1 share of stock, right? 1 share through 20% of the common stock. Everybody got it? Those would be marketable securities, if they're current, trading securities and available for sale, or they'd be investments available for sale if they're long-term, right? So short-term and long-term just means what? How long you're going to hold it. So within this, guys, how long would I be holding it if it's a trading security versus available for sale? This is a few days, maybe up to a few weeks. Very short term. No, there's no maturity. This is common stock. This is common stock. Investments in common stock. If my intention is to hold it just for a few days. So I'm buying stock and I know I'm going to need the cash later. I'm not putting the money in a savings account because it doesn't earn any interest. I put it in the market, right? Because I think it's going to earn better. Expected earnings are better. Remember, there's risk, so it could go down in value too, right? So you take some risk. But you expect it to get high, okay? You're expecting dividends. So I'm investing very, very short-term on trading securities. And we're going to account for it differently because it's a trading security, and the idea is I am investing very short-term, okay? Everybody got it? So it'd be a few days up to a few weeks. Guess what available for sale short-term is then? Still investments in common stock, right, of other companies. But how long am I going to hold it? Less than a year. More than a few weeks, up to a year, right? So less than a year. Everybody got it? So how would I determine if an investment is trading security versus available for sale short term? How long am I going to hold it? Judgment call, okay? I have to guess how long I'm going to hold it. What's my plan? Got the idea? Okay. Guess what available for sale long term is? More than a year. Once you see this, it's just nothing to it. And it makes sense, doesn't it? Everything always makes sense once you understand. Everybody good? Okay. So, what other categories might I have? All of these we'd say were passive, okay? We're passive investors, right? We're not making anything happen. We're just taking whatever they give us in dividends and whatever stock appreciation we get, stock increasing in value or decreasing. Yeah, like, right? Everybody agree? We're taking what the market gives us. We're passive. Okay, so what would it be if you're active? So there's going to be 2 categories here, and it's based on control. If I own 1 share up to 20%, how much control do I have? We'd say no control, guys. Got it? No control. None. That makes sense? Okay. All right, down here, what would I have? When would I have total? Well, significant. Okay, I got it. I'll take that. Significant what? Influence. Excellent. Okay, and what's the other possibility? I can have no control, I can have significant influence, or I could have what? I could have control. Got it? Those are the 3 categories. When do I have control? When we vote, I win. Anything over 50, right? Over 50%. 1 share over 50%, right? We have 100,000 shares of stock. I own 50,001 shares. You own 49,999. Let's vote. Who wins? Me. I run the company. Got it? So if you own more than 50% of a company, you own the company effectively. That's how we're going to account for it. Make sense? I would be the majority shareholder because I like being the majority shareholder. Not really in any company. Never have been. Right? But pretty cool, right? Especially with a lot of money. Okay, anyway. I'm the majority shareholder. She's the minority shareholder. And that's, guess what? We call her share the minority interest. What do you think? Good idea, seeing as she's in the minority and I'm in the majority. Now, by the way, there could be a whole lot of shareholders, right? but I own more than 50%. My subsidiary, even if there's 1,000 other shareholders or 100,000 or a million. Got the idea? Still my subsidiary. Oh, it's a portion of my company. I'm going to call it a subsidiary. Yes, sir.
If you're a company, can you control who buys your stock?
There are ways that you can do that. If you are a closely held company, you don't have to sell the stock to anybody you don't want to. But you can't, closely held means only a few people on it. But you can't control who you're the other owner sell to. Unless you have an agreement to some effect, it has to stay in the families or something like that. You have that, yeah.
Isn't treasury stock where you buy it from the shareholder you don't really like?
It could be. You might buy treasury stock to get rid of the shareholder, or to get rid of somebody who's trying to take over your company, right? Corporate raider. Yeah, that's true. You could. But,
Because I was like wondering, like,
you can't stop people from buying it in the market. You can't, if you're a publicly traded company and the stock's being sold on the New York Stock Exchange, you can't say, no, I don't want that owner. They can buy the stock if they want, right? The market won't allow you to do that for obvious reasons. They want that stock to sell. Forget it. Okay. So there are ways. Brown-Forman is an example. They have two types of stock. They have Class A common stock and Class B common stock. You can buy their Class B. You can't buy their Class A. The Class A has all the votes. Oh. So you can buy the B if you want. It's all right. It's like buying preferred stock or something, right? You don't get to vote. Why would anybody want to do that? Oh, by the way, who owns the Class A? The family, right? And their descendants. So it's still controlled, right? But it got real big and real rich. Why would you want to own the Class B stock? Because it increases the value, pays dividends, right? It's valuable, right? That's why you buy it. It's a really good company. It's the only way you can own Brown-Forman. What does Brown-Forman make that you guys might be familiar with? Never had a sip of it before, but maybe familiar with. Ever hear of Jack Daniels? Brown-Forman. Okay, so yeah, and then any bourbons too, all kinds of stuff. Okay, and Southern Comfort might be them too now. Yeah. Anyway, okay, so. But we can't talk about alcohol in classes, right? Okay, we used to be an alcohol-free campus. Are we still? Yeah, are we officially? So now we have a bar on campus.
do we?
Anybody over 21? Apparently they opened a bar on campus. Yes, downstairs. I'm not supposed to probably tell you. They don't even have a sign or anything. They have a bar. No, it's downstairs from the dining hall. A little room down there. And faculty and students get together and have a drink, I guess. I haven't gone. But I heard about it last semester. And I was walking by there and I looked in the window and yeah, there's bottles of booze sitting in there. Yeah. So don't break it. No. You would. Okay. All right. So no underage drinking. No underage drinking. Anyway, I think that's fine. Okay. So what did that answer your question though? Did that get it? Oh, and then I cut you off. What were you going to ask her? Talk long enough, you forgot.
I think we got it.
Okay, good. All right, cool. All right, if it comes back here. All right, so here we go. What would we call these? I already said if we have control, we're going to call it a subsidiary, okay? So it'll be investment in subsidiary. Got it? Investment in XYZ company subsidiary, okay? A subsidiary is a subset of me, okay? I'm the parent, they're subsidiary. So it's a parent-subsidiary relationship. That's where you have control. Everybody got it? That's where you have control. So that's one category we've got here. So now, so far we've got two on long term. We have investments where we have less than 20%, right, of the stock. So we have no control, and we call those available for sale long term. Got it? If they're long term. If they're short term, of course, call it short term. If it's real short term, a few weeks, trading periods, okay? If I own over 50%, I call it an investment in a subsidiary, okay? What do I call it if I have significant influence? Well, what do you think significant influence is? Seeing as less than 20% is no control, more than 50% is control, guess what significant influence is? Between 20 and 50%. Got it? And the 20% is just a judgment. Really what the deal is if you don't run the company, right, if you have no control over the company, it's no control. What if I own 25% and somebody else owns 75%? I'd still say I have no control. Got the idea? Okay. What if I own 10% but I have the right to run the company by agreement? Now I got significant influence. Got the idea? Okay. I'm still not a subsidiary. Right? Still not total control. Everybody got the idea? What are we going to call these?
Investment affiliates.
Investment in affiliate. You got it. So you need to be able to handle all of these. So this is a tough chapter just because there's all these different categories. Okay? All right? And those are non-current, of course. If I own 30% of the stock of a company, what would happen if I sold it tomorrow? Boom, the bottom falls out. I'm not selling tomorrow. It's a long-term investment. What if I own more than 50%? Even worse, right? So I'm not going to flood the market with that stock all of a sudden. Okay? So I've got, if I have significant influence, it's long-term. If I have control, it's long-term. Got the idea? That's common sense, isn't it? Okay? So what we need to do is be able to account for all of these. So we're going to have different methods of accounting based on how long I'm going to hold it and how big my investment is. Okay? Where does how long I'm going to hold it matter? Whether the marketable security is a trading security, an available for sale security, short-term or available for sale long-term, right? That's where how long I'm going to hold it matters. Where does how much I have matter? Is it a marketable security, less than 20%? Is it investment in affiliate between 20 and 50? Or is it investment in subsidiary over 50? Everybody got it? If you see those, you got it made. If you just try to remember this stuff, oh man, it'll just disappear. But it just makes sense, okay? All right. So what method of accounting are we going to use? Okay, if you have an investment in common stock of a company, and it's publicly traded, can you figure out what its market value is? Yeah. You can look in the Wall Street Journal, you can look online at Yahoo Finance or MS Finance, you can look it up, right? It's reported constantly. It's half-hour-old data on Yahoo. You can see what the stocks were worth a half hour ago. I'm not kidding, right? What it was trading for a half hour ago. Why won't they give you the real current stuff? They just pay for that, right? You can buy a service, it'll give it to you right now. They're trading it right now. New York and American stock exchanges, London stock exchanges. They're exchanging shares right now, so we know what the price is of everything right now. Everything is publicly traded. So what we do is we use a market value method. Sound good? Because we know the market value. For all of our trading securities, available for sale short-term, available for sale long-term, we're going to use market value. So anything that is a marketable security, we're going to use market value for. Got it? We're going to adjust the market value at the end of each year. If I bought a share for $100 and at the end of the year it's worth $98, I'll have a $2 loss on it. Sound okay? All right, and then we're going to have different ways of accounting for the losses based on how long we're holding it too. Kind of unfortunate, but it's true. So this is going to be market value method, okay, guys? This is going to be market value method, okay? And this one's going to be market value method. Oh, that makes sense. Because I'm just taking whatever the market gives me, so it's the market value method. I'm going to adjust the price to the market value. If I sell the stock, I'll have a gain or loss of selling it, right? But even if I hold it, I'll have a gain or loss because the value changed. And I'll have dividend income from it, right? So they give me dividends. Everybody got it? Okay, that's going to be true on trading securities, available for sale short-term, available for sale long-term. Now, it's different in the investment in the affiliate. We're going to use something called the equity method. And the idea here is, you guys, we are not holding the stock to get the dividends. If we get a dividend, we decided to pay ourselves a dividend. So we're going to use the equity method. We decided to pay ourselves a dividend because we voted to pay ourselves a dividend, right? So we're going to treat it as a reduction of our investment. Is the way it will work out. Because I'm taking out some of my investment. And what I'm going to do is I'm going to help run the company. Because I own between 20 and 50%, I'm helping to run the company. So then what happens? If they're net income, my share of the net income increases my investment. So if I own 30% of the company and they make $100,000 in a year, I'm going to increase my investment for my 30 share, right? 30% of the 100,000. Okay? So I'll debit my investment. I'm going to credit income from affiliate. It's going to go on my income statement. Got it? What if they paid me a dividend again? I paid myself one. I'm going to debit cash for the dividend coming in, and I'm going to credit the investment for it. Okay? I'm going to go through all these entries. Okay? I'm going to go through all these entries, so relax. Okay? But yeah, this is what the deal is, and the author goes through them. Okay? I think my approach is a little clearer than that. I pay a lot of attention. That names are going to look a little different, and the approach is going to look a little different. They kind of blend them all together. You get really confused. I make them real simple for each of these. Okay? This, by the way, is a fairly new thing that we use market value. What do we usually keep all of our assets at? Historical cost, or depreciated value on equipment, no. The historical cost less accumulated depreciation. This is different. Why is it different, this market value thing? Because we know the market value, we go ahead and adjust to it. Don't you think we should, where we know the market value, put the market value on the balance sheet instead of the historical cost? I think we should, where you know the market value. Problem is if you don't know the market value. When do you know the market value of land that you're holding? When is the only time you know the market value? Sell it. That's when you know the market value. Otherwise, you'd be dependent on appraisals, wouldn't you? And I hope you guys know by now, appraisals are not very dependable, right? Part of the banking fiasco that we had, collapse of the banking system, kind of, right? Subprime loans and all that stuff on real estate. Appraisers would find out how much the loan was that they wanted to loan you, the money they wanted to loan you, and they made sure the appraisal was more, so they could justify the loan. And everybody got their fees. Didn't matter if the property was really worth it. How do you know that the property's really worth it unless you do what? Sell it. I told you this before, right? If we go, we're going to buy a brand new Mustang. My wife kind of wanted one for a while. That's kind of cool. She thinks we're too bad. Okay, we're going to go buy a brand new Mustang. It's $25,000. Something, maybe it was 30, but she went up. Like $30,000. Stickers, $30,000. You go in and you get yours for 25. I go in and I get mine for 30. What was yours worth?
25.
What was mine? 30. What I paid for. That's historical cost. Is that a problem? Oh yeah, that's a problem, isn't it? Because it's exactly the same car with no miles on it. We're driving it off the lot. Exactly the same color, everything, right? Same interior, same engine, everything, same car, right? When we drive down the road, is mine really worth $5,000 more than yours now? If we tried to sell it, no way, huh? Yours is probably worth more than you paid for it. Thank you. Mine's worth a lot less than I paid for it, right? We try to resell. Got the idea? But you got a really good deal on it. Everybody good on this? Okay. So how do we know what the value is of that car? Especially after we drive it 50,000 miles. Sell it. You can look up estimates of it, blue book values and stuff, but that's just an estimate. I might beat mine up. Yours might be in really good shape and you take care of it. Even though they have exactly the same miles. What's going to happen? Yours is worth more than mine, right? Can't even look up the value of blue book, can you? Not really. Everybody got the idea on this? Okay. So here, though, we know the market value is trading. So we're going to adjust the market value. That's all. All right. Why don't we adjust the market value on the investment in the affiliate? Because we're controlling things, right? We have significant influence. And besides that, we're not holding it for the increase in stock price. We're holding it to run it, right? To get our share of the income. How about if it's a subsidiary? I own more than 50%. So it's a subsidiary. Here what I'm going to do is consolidate, okay? So the method of accounting I'm going to use is consolidation. And we're just going to touch on this in this class. Those of you who become accounting majors are going to do these methods in advanced accounting in depth. The 400 level class, senior level class, okay? Do that in nonprofit in that class. It's a tough class and it's the whole class. So this is a big area. Anyway, so this where you have control, it's going to be an investment in a subsidiary and you're going to consolidate. Here's the deal. These subsidiaries don't really exist because the parent controls them. So what you do is you add together the assets of the parent and the subsidiary. How many subsidiaries might a company have? Hundreds if they're big. You put them all together. Add together all their assets. Add together all their liabilities. And eliminate the equity of the subsidiary because the subsidiary doesn't exist. But when we eliminate the equity of the subsidiary, we also eliminate the parent's investment in the subsidiary. Because if you added the assets together, what would you have? Investment in yourself. An equity that doesn't exist. So we eliminate the investment and we eliminate the equity. That's the theory on this. By the way, what if you're doing business with yourself, right? The parent and the subsidiary are doing business together with each other. One has a receivable, the other one has a payable for exactly the same amount, right? They owe each other money. We'll eliminate that too. You can't owe yourself money, right? It's meaningless. What if you sell stuff to each other? You have sales, and you have cost of goods sold and other expenses. You can't sell anything to each other. You have to eliminate all that too. Imagine if you got 200 subsidiaries and they're all doing business with each other, what kind of a job this turns into, right? But what do you want to tell people when you give them the consolidated financial statements? The statements you've been looking at, the real ones, they consolidated on, don't they? There's parent and subsidiaries consolidated. You can read the notes of the financial statement, find out who their subsidiaries are, right, or what the groups of them are. Okay, you can look out on their webpage, find out who they own. Okay, so what's the deal? I want to tell people what the company really looks like if you're investing. You buy the parent stock, you don't buy the subsidiary stock, right? Because it's 100% owned subsidiary. Nobody owns it but the parent, right? Got the idea? So we gotta have it. Okay. So those are the things we're gonna do. We're gonna use market value method, equity method, or consolidation. Everybody good? Okay. Any questions? Is your head spinning? Those of you who read the chapter, your head's not spinning. Those of you who didn't are kind of like, what is he talking about? Every time. We're gonna start cash flow next time. Oh, that handout I gave you for cash flow. Everybody got it? You got that handout? Get a copy from a friend if you don't. Bring it up, okay? Gave you a handout, 2 cash flow problems. I gave you the answers. For next time, have them work. I'm going to show you how to do cash flow next time. Right? And then the time after that, we're going to finish cash flow, and we're going to finish this investment in other companies. And then the time after that, we are having a quiz, aren't we? Boom, boom, boom. Okay? Cash flows is one big problem. Right? Work them. You've got it sitting right there. Work those. Now, don't look at the answer until after you do it. The answers are on the back of the page, I think, right? Don't look at the answers and then do it. You know, that's not going to work, right? Work them. Okay, work the first one, then look at the answer, figure out what you did wrong. Then work the second one, right? And then look at the answer and make sure you did it right. Why am I not using the problems in the book? Because they're too simple. They don't show you the whole picture. They show you the whole thing all in one piece, okay? So you can really see what a cash flow statement looks like and how one works. By the way, on cash flows, you don't need any more journal entries. None. You don't have to make a single journal entry to do a cash flow statement. Just analyzing what happened to cash and what happened to the balance sheet. Did you guys know that beginning cash plus cash in plus cash out is ending cash? You can put it on a statement. I'm not kidding. Where did the cash come from? Where did it go? That's what the cash flow statement does. Does cash matter in business? Well, yeah, you run out of cash, you're broke, right? Bankrupt problem. Okay, so it matters. Is it more important than the income statement? No way. The income statement predicts future cash flows. The cash flow statement just shows you the current year cash flows. What do you want to do if you're investing your money? Do you care what current cash flows were or what future ones are, seeing as you're buying the stock now and you're going to get the returns in the future? I care about the future. So accrual basis income statement is a far better predictor of future cash flows than the cash flow statement is. Ready to hear that? But the cash flow statement is still real useful, right? Okay? So it's additional information. All you do is analyze the balance sheet. Cash in, cash out. Write it down. Okay? We'll be very methodical about it, and I'll try to make you understand what you're doing. Give it a shot. Okay? For next time, give it a shot. It'll make it so much easier for you. Oh, by the way, you need to read the chapter before you work the problem. Oh no, I don't ever do that. Okay, anyway. I always try to do stuff without reading too, and then I get in trouble. And when you put together something, you know, if you buy some, I've got a bicycle I got to put together for my grandson. Still haven't done it. I got to put his bicycle together. It's in my garage, and it's really too big for him anyway. Still, but his mom got carried away, so he's got this bike sitting out there. I'm not going to read the instructions. I'm just going to put it together, right, guys? Yeah, I will. And then you know what I'm going to do when it doesn't work and there's parts left over? I'm going to read the instructions. Do it every time. Don't you guys do that? Don't do it like this. It's not going to work very well. It's just way too complex. Give me a check. Told you that a million times. All right, so let's do these, okay? One other piece. I only talked about common stock so far. What if it's an investment in preferred stock or an investment in bonds? Now listen to this carefully, if I'm holding the preferred stock or the bonds for only a few days to a few weeks, guess what I'm going to call it? Even though it's a bond, I'm going to call it a trading security. Can you figure out the market value of bonds at the end of a year, end of a month, end of a quarter, end of a year? Sure you can. You can look them up. They're publicly traded, right? Got the idea? Or you could compute it again. You guys know how to compute the value of bonds too, right? So if they're not publicly traded, you could compute the value. Okay? So if it's a trading security, we're going to use the market value method for it. Oh, same with preferred stock. Preferred stock and bonds both. How about if I'm going to hold it for less than a year, more than a few weeks, but less than a year? They go in avail for sale, short term. What if I'm going to hold it for more than a year, but not to maturity in the case of the bonds? Got it? But I'm going to hold the preferred stock for more than a year. That would be avail for sale long term. Would I ever use investment in an affiliate for bonds or preferred stock? No. You can't have any control with those, right? You don't vote. Will I ever consolidate based on preferred stock or bonds? No. But there's one other one that you already did for bonds. What was it? It's long term. Investment in what, guys? Held to maturity bonds. Excellent. If my intent is to hold the bonds for the whole time, right? I call it an investment in held to maturity bonds, and how do I account for that? Discount, premium, and amortization, right? Effective interest amortization, everybody agree? I'll either have a discount or I'll have a premium, and I'll keep it at its amortized value, won't I? Discount or premium. That says discount or premium on us. Okay, discount or premium. Everybody good? That's how I'm going to account for that. And then I'm going to amortize. You already know how to do that. So with bonds, what is the possibility? It could be a trading security. It could be available for sale short term. It could be available for sale long term, or it could be held to maturity. Everybody got it? For preferred stock, what could they be? Trading security available for sale short term, available for sale long term. Okay? And those we account just like we would for common stock. Okay? All market value. Everybody good? So you have to decide on the bond if you're holding it to maturity or if you're going to hold it just for a short period of time. Or for maybe more than a year, but not maturity. 10-year bond, you're only going to hold it a year or two, right? What would that be? Available for sale. Got it? Okay. Credit market. All right, I won't get too fancy on the problems. I need to know that. All right, gang. So, let's try something. Okay? Let's say we've got a company, XYZ company, okay, and they have 100,000 shares of stock. Oops, shares, not dollars. Okay. And let's say that they've got par of $1. And let's say the market value at the time I buy it is $10. Okay. Make our math relatively easy. Okay. So far, this is the company. Everybody good? XYZ company. We're going to invest in that. Okay. So I'm ABC company, right? And I'm buying XYZ. Everybody got it? Okay. By the way, XYZ could care less that I'm buying their stock. Probably. Unless I take control of when I run the company, I guess, right? But people buying and selling for stock, they're not going to make any journal entries for us. They already issued the stock to somebody on the stock market. Now I'm buying it, so what? They don't have a journal entry, right? Ah, so you bought the stock, now you're selling it for her, right? Company doesn't change. Everybody good? Uh-oh, door broke. It's kind of dark over there, isn't it? All right, anyway. That's okay, you can open that door, I don't care. All right, anyway. So let's say first that we own 10% of the company. Okay, so we'll do 10%. All right, I buy 10% of the stock. Give me all the transactions related to this stock. Well, first, let's do the investment in the stock. 10%. So let's say I buy it January 1st, it doesn't matter. I buy 10% of the stock. So that's the first one. Okay? So what method of accounting am I going to be using? How much influence do I have? None. No control. Right, guys? So we're doing the no control case. All right, here we go. Let's record the investment. Let's do the easy part first. How much cash are we going to get? We're paying cash. Okay, it's gonna be 10% of 100,000 shares is how much? 10,000 shares. How many dollars am I gonna give them? 100,000, it's $10 a share, right guys? I'm sorry, yeah, $10 a share, 10,000 shares. Everybody good? Everybody sees where I got 100,000. I wanna know what I'm gonna debit. I have not given you enough information yet. Ask me a question. Yeah, what do you mean? I'm investing in common stock. That's the common stock. How long are you going to hold it? Yes, this is common stock, okay? How long am I going to hold it? Okay, I'm going to hold it for a few days. Excellent. Trading securities. Good. Investment in trading securities or just trading securities. Okay, that's a debit, okay? 100,000 debit, and then I got cash, 100,000 credit. Everybody see it? All right, let's assume instead that I'm gonna hold it for, let's say I'm gonna hold it for just less than a year, more than a few days, but less than a year, okay? So let's say 6 months. Instead of a few days, I'm gonna say 6 months. Now what is it? Available for sale. Short term. Excellent. 100,000 debit. Just a different asset, right? And credit. Everybody got it? This is too easy to believe. Okay. Short term. Available for sale. Short term. Okay? All right. Now. Thought I made it small. Available for sale. Short term. Okay, guys? All right. What if I'm going to hold it for more than a year? This is too easy. Available for sale, long term. So when you're looking at a problem I give you, what do you need to decide? If it's less than what percentage, it's going to be marketable securities. All these are marketable securities, right? If it's less than, I'm sorry, the first two are marketable securities, short term, and the other available for sales, long term. But these are investments where I have what? No control. If I own less than how much, guys? 20%. We'll use that as a rule of thumb, okay? 20%. Right, so that's all of those, huh? Everybody good? It really isn't bad, is it? Okay? Let's say instead, I'm going to buy, let's say I bought 30% of the stuff. How would I record that? What's 30% of the 100,000 shares? 30,000 shares. What's $10 times that market value? 300,000. How much cash are you going to give? 300,000. It's too easy. What am I going to debit? I've got 30% of this stock. Am I going to hold it a few days? Only if I want to lose a fortune. Buy 30% of a company and then sell it in a few days. Good luck. Right? Time doesn't matter. Because I'm going to assume I'm going to hold it what? Yeah, it's investment in affiliates. It's long term. This is long term. It's investment in an affiliate. How much control do I have over this affiliated company? Investment in affiliate XYZ, right? But XYZ company, that's their name, right? So investment in affiliate XYZ. That's a debit. Key. Credit, right? Investment in affiliate XYZ company, 300,000, right? Credit cash, 300,000. Everybody good? How much control do I have? Significant influence. That's the point, right? I own between what and what? Yeah, between 20 and 50%. Got it? Significant influence. I'm helping run the company. Everybody see that? Not too bad so far, huh? Too bad. Okay. Let's do one more. I buy 60% of the stock. Okay. How much would I pay? How many shares do I get if I buy 60%? Yeah, there's 100,000 shares. I buy 60%. I get 60,000 shares. What did I pay per share? $10. And what is that? 600,000. Credit cash 600,000. Everybody agree? Okay. And what's the debt? Investment in subsidiary, and put their name on it. Got it? XYZ company. That's 600,000. That's the debit. This one's a credit. Hit it again. There's the debit. There's the credit. Everybody got it? Could you handle those? That's the original investment. Okay. Then what do? Well, the company runs, right? This company we have an investment in runs. And as a result of running, let's say they pay $20,000 in dividends. Okay? And let's say they report net income of $80,000. And let's say this is the market value when we buy, it was 10, right? Let's say the market value goes up to $11. Okay? Everybody got it? So this is the ending market value, end of the year. Okay? So now the market value is 11. It started at 10. Everybody with me? So I had a gain of $1. Would you agree with that? No matter how many shares I own, I really did increase the value by $1. All right. So what do? Tell you what I really like to do first is the one where I'm going to consolidate. Because I'm going to eliminate any dividends for myself. And I'm going to, if I recorded the change in market value, I'm going to eliminate it anyway. So you know what you can do on the consolidation one? Nothing. When they pay me my cash, by the way, how much dividend am I going to get if I own 60% of the company? They pay $20,000 in dividends. How much are you going to get? I own 60% of it. They're paying $20,000 total, all the shareholders. What do I get? $12,000. I'll debit cash and credit probably dividend income, right? I won't have to do that in the Quizzer test. Because guess what we're going to do with the dividend income that I got for myself when I consolidate? I'm going to eliminate it. It doesn't exist. But I can't eliminate the cash, so it's just a little more complex. Not a lot. But I won't do that to you in the Quizzer test, okay? I won't have dividends under consolidation. Okay? All right? Besides, if I owned 100% of it, would I ever pay myself a dividend? What for? Okay? My cash to me. Okay. So anyway, but if I own 60%, I don't have to vote to have a dividend if I don't want it, but I can if I want it. The other 40% of the shareholders might want a dividend, right? I'm not going to keep them happy. All right. So we won't worry about dividends, and we certainly won't worry about changing market value. All right. What did we call the method we're using for all these marketable securities over here? Market value method, right? I am going to adjust the market value on all of them. Okay? What method did I say I was going to use where I have significant influence? Equity. I am going to record my share of their change in equity, their net income and their dividends. So a whole different mindset. How much control do I have over these marketable securities over there? Trading securities available for sale short term, available for sale long term. How much control do I have? None. Okay? So when they report net income, what am I going to do? Nothing. If they pay a dividend, though, I have to record the dividend coming in, right? Everybody good? If I'm equity method, when they report net income, I help earn some of that. I'm going to report the income, right, on my income statement. Got it? And record an increase in my investment. When they pay a dividend, I'm paying myself a dividend. I'm going to record the cash coming in and reduce my investment. That's simple. Okay. So maybe first we'll do the easier one. The investment, because there's differences among the three over here where they available for sale in the trading securities. Let's do the easy one here. It's now let's say they paid the dividend on December 31st, and we have the income on December 31st reported, and we have the change in market value at December 31st. So let's figure out what we would do. First, let's do what we do for the dividend, right? Then let's figure out what we would do for the net income. If it was net loss, we'll be reducing our equity. If it's net income, it increases it. That's true, right? Net losses reduce your equity. Net income increases. Yeah. Okay. So we're going to adjust the investment the same way. Okay. And then let's do the change in market value. That's a triangle change in market value. Okay. So how much was the dividend? Total. 20,000. What share of the company do I own? What's my share of the dividend? 6. So what do they pay me? What's the dividend going to be? In what? Cash. Debit cash, 6,000, right? Credit what 6,000? What we're going to credit is dividend revenue or dividend income. Either term is fine. Okay? Dividend revenue or dividend income, $6,000. Is that all right? Oh, I screwed up. I already screwed up. Scratch that. Get rid of that. Oh my gosh. I was doing the market like that. Okay? No. What is this to me? I paid myself a dividend. I own 30% of this company. I voted to pay myself a dividend. Okay? So what happened? I have an investment. Looks like this. I have an investment. Right? This investment account, affiliate, where I put $300,000. Right? What did I just do? I just took 6 of it out. Okay? I only have a $294 investment account. I took 6 of my own money back because I voted to take it out. Right? Okay? So it's debit cash and credit investment and affiliate. Sorry, deficit. Investment in affiliate. Excellent. So, as I receive the dividend from myself, basically, right? I reduce my investment. But the idea, I voted to give it to myself. So if you invest in something and you take some of it back out, does your investment go down? Went up when you put it in, right? When you took it back out, it went down. That's what the theory is. And why do we think that's the case? Because I have significant influence. I made the dividend happen, right? I helped vote for it. All right, good. So then what would we do with the net income? Take my share of net income and add it to the investment, because isn't my investment more if it earns? As their equity goes up, right, I increase my investments. What's happening? Okay, as the equity company, the affiliate goes up, I increase. So how much income did I say we had? 80,000. Okay, what's my share? How much is that? 24. So I want to increase my investment by the 24 earnings. That makes sense? So I'm going to debit investment in affiliate. Why didn't they give me a really big board to write on? Investment in affiliate, right? For how much? 24,000. And what do you want to credit for 24,000? Income from affiliate. That's good though. It's not really revenue because it's the difference between their revenues and expenses. It's our share of their net income. So equity interest in affiliate income, people call it, right? Income from affiliate, people call it, okay? Either of those are fine. Variety of terms. So income from affiliate would be just fine. So what am I doing? I'm increasing the investment by the 24 and I'm increasing my retained earnings, right? I'm increasing my net income by the 24 and my retained earnings by 24. So I'm increasing the asset, right? And increasing my equity by the same amount. Everybody got it? That's all that's happening. Okay, so what's my ending investment? I start with 300. I add 24. I know you can see that, probably not. And then I got 6 coming out. What is that? 318. And what is that composed of, you guys? My beginning investment of 300, less the dividend I paid myself of 6, made it 294, plus my share of the income they earned of 18. You guys with me? Of 24. So 6 going out, 24 coming in, net 18 increase for the year. Everybody see it? My carrying value is down 318. Did you do this? By the way, what do I do with the change in market value? No entry. I am not holding the stock for increase in market value. So no entry on that one. Make sense? I do care that the stock price went up. I like that. I'd care if it went down. I wouldn't like that. But I don't record anything. I'm not holding it for stock appreciation. Everybody see what's going on with that one? That's the equity method. Okay? So now let's try the market value method. Now the market value method, there's basically 2 ways that we're going to do this. One is for the trading securities, and the other one is for the available for sale, for both types. Okay? Here's what the deal is. The change in market value, if it goes up, it's income, right? But it's unrealized income. If it goes up, it's an unrealized gain. What is unrealized gain? What's recognized? I told you guys this several times. What is recognized? I recorded it in a journal entry, right, guys? I recognize revenue, I recognize expense, but I just recorded it. I recognize assets, liabilities, and equity, right? That's recognition. What's realization? Got cash. Okay, what do I mean by unrealized? Didn't sell it, don't have the cash. But I still might recognize the gain or loss, okay? I'm certainly going to recognize the change in market value. I mean, if I bought it for $100, well, what did I buy it for? I bought it for $10 and now it's worth 11. I'm going to increase every share by a buck, right? My investment goes up by about 10% on across all of it, right? That makes sense? So how much did I invest in the stock? I bought 10%, didn't I? In the trading security, I've got 10%. I own 10,000 shares. It was worth $100,000, right? When I invested in it, I bought it for $100,000. What's it worth now? 110. So I'm going to debit either trading security, available for sale security short term, or available for sale long term, depending on how long I plan to hold it. I'm going to debit 10,000. That make sense? Now here's the difference. Listen to this. I am going to credit unrealized gain on either trading security or available for sale security short term or available for sale long term. It's real straightforward, right? Because I have the gain. If it was a loss, I debit loss and credit the investment, right? It's going down and down. Okay? So I'm going to adjust the asset, trading security, available for sale short term, available for sale long term, to whatever value it is now, right? I'm going to adjust it, okay? But here's the big difference. That unrealized gain or loss on trading securities goes on the income statement. The unrealized gain or loss on the available for sale short term or long term goes straight into an equity account, which is an other comprehensive income account. This is weird. I lied to you guys when I said there were only 5 accounts, didn't I? And there turned out 5 types, and it turned out to be how many? Because it was contra everything? 10. A little white lie to make it easier at first, right? I knew I was lying when I did it. Okay, a little white lie. Like my wife says, does this dress make me look fat? What do I say without looking at her? Of course not, sweetheart. Right? That's a little white lie. I don't even know it's a lie because I don't go there. Right? Of course it makes her look skinny. Right? Absolutely. Okay? She is pretty good. Okay? Right? So, you got the idea though? Right?
Say that one more time. So you debit increase.
You want to hear about my wife? Yeah.
Securities are available for sale.
Okay, if I want to increase them, if they're increased in market value, I debit it, right?
Yeah.
If they decrease in market value, I credit it. Make sense? Okay, so if it goes from 100 to 110, I'll debit it for 10. If it goes from 100 down to 95, I'll credit it 5. And then where does the other side go? Unrealized gain or loss. Right? It's a loss if they reduce in value. It's a gain if they increase in value. That's great. And I'm going to show you. Okay, too. I'll write it down. But yeah, that's exactly it. Good question. Okay? So, what do you think, guys? Why would we put, I was telling you about the lot. Sorry. There were 5 accounts, I said, and there are really 10. Well, here's the next one I told you there's only contributed capital and retained earnings. didn't I, in equity. There's another type of equity that I didn't give to you. So let me show you that. Here we go. In our equity section of the balance sheet, yes, we have contributed capital accounts, common stock, preferred stock. Yes, we have retained earnings. And then we have this strange thing in between called other comprehensive income. And we are going to accumulate other comprehensive income. What these things are items that we couldn't agree what to do with. We don't want to change retained earnings. We don't want to put them into retained earnings in the first place through the net income, right, through income statement. We don't want to directly change retained earnings, and it doesn't have anything to do with the owner's contribution. So here's what it is. On the trading securities, we think that whatever change there is in price probably isn't going to change before we sell the stock, because we're going to sell it real soon. That sound okay? Or the bonds, or whatever the trading security is. We think it's not going to change, right, before we sell it. So we go ahead and put it on the income statement, okay, as a gain or loss. And it runs through retained earnings like any other gain or loss. Got it? You know what gains and losses are on selling buildings and equipment. It's the same sort of deal, right? Okay? But it's an unrealized gain or loss. But it hits the income statement. Big difference, okay? But the available for sale ones, because we're going to hold it for more than a few weeks, guess what will happen? Probably the market price will change. So here was the compromise, right? Don't show them in the income statement. Put them directly into an equity account, an other comprehensive income account. This is your first one of those. There's only a few, really. Foreign currency translation gains and losses, where we haven't brought the money back into the U.S., it's still in another country, but it changes in value because of exchange rates between countries, right? That'll show up there too, okay, in other comprehensive income. Do you want to read about other comprehensive income on a financial statement? Why am I having you do this if you're never going to do another accounting class, which you both are? Or at least half of it. What do you think? Why would I do that? I want you to know what this stuff is. You're going to be reading financial statements, you guys. You're going to be using them. Where would people like to put the bad things? On the income statement or straight into an equity account? If I could bypass the income statement, I'd be happy with it. It's bad news. It's good news. I'd like it on the income statement, wouldn't I? Right, other gains in the income statement and losses go straight into other comprehensive income. You don't get to do that, right? Okay, so the compromise was, well, we're worried about this changing value, right? So we're going to, first it was going to be the long-term ones would go into other comprehensive income, and the current ones, less than a year, would go into the income statement. Nobody would buy into that. So it all got all the way down to really short holding period, right? To get the income statement, just the trading securities. And then the available for sale short-term and available for sale long-term go to other comprehensive income. The other thing that's going to be in that other comprehensive income account is pensions. A whole lot of companies have these pension plans where they guaranteed retirement for their employees, but the money was not put into the plan. Sometimes it was a union deal, and the union negotiated what the pension was going to be, but nobody negotiated making contributions to the pension plan. It's just nuts. And then the federal government guarantees it, only it doesn't really guarantee it. They only get 50, 60% of their pension, depending how big the pension is. It's a real mess. It's a real scandal in the U.S. Okay? It's just a real disaster. Anyway, so these people thought they were going to get really nice retirements, and they get half of it, or less, sometimes none of it, right? But the government is guaranteeing it, and taxpayers are paying for it, and that's a big scandal, right? Okay. Anyway, so now what happens is you have to record your full liability for the pension, right? Change the rules. You have the guidelines. You have to record the whole liability. But then that's a credit to liability. Where does the debit go? Other comprehensive income. You want to read financial statements to see how big the other comprehensive income is, especially if it's a big loss. How if the loss there is bigger than your retained earnings? Oh, that's not good enough. Okay, so you need to know what this stuff is. Okay, anyway. And that's all we're going to get on other comprehensive income. So that's kind of scary, isn't it? Going after careers. So take 211, we'll do a lot on it. Okay, anyway. So here we go. How would we record these? Let's do the entries, and I'll let you guys out of here. Now, they're going to be a little different. On the trading security one, what would it be? So let's do first this one. We'll do 1, 2, 3. Okay? So for the first one, for trading securities, right guys? Right, that's 1 up there. Okay? What would we do when they report the dividend? Right? Same 3 things. We've got the that we had over here, the dividend, the net income, and the change in market value. Dividend, net income, change in market value. Okay, guys, how much was our share of the dividend if we own 10%? It's a $20,000 dividend. We own 10%. We got $2,000, right? I am just taking what the market gives me. Debit cash, 2,000, and credit dividend revenue for 2,000. I didn't decide to pay myself a dividend, right? Other shareholders did. Got the idea? All right. How about then on the net income, my share of the net income? I did not make it happen. I don't have any control. What would I say? No entry. Excellent. So if you can keep these straight, you got it made. Change in market value, I'm taking what the market gives me. What would it be? Increase trading securities. We're doing trading securities first, right? Increase the account trading securities by how much? What are they worth now? I paid $100,000 for them because it was $10 a share on 10,000 shares. I still have 10,000 shares. What are they worth now? $11 a share. What do I want that account to have? 110. How much more do I need to put in? 10. Debit 10,000. And we'll do this again before you have the quiz. Credit 10,000 to what? What is that going to be? Unrealized gain. Why is it unrealized? Well, I'm recording it. This is on the income statement even on this case. I'm recording it. That's a journal entry. But I haven't realized it yet. What does it mean? I haven't sold it. I haven't received the cash. Right? I'm just holding it. It's a holding gain, right? Some people even call it an unrealized holding gain. Okay, it's all right. Got the idea? On trading securities, right? Unrealized holding gain on trading securities. That's going to go on my income statement, okay? Well, this is going to be really easy. You're going to like this. These are so similar to each other. All right? Let me get rid of this stuff. So I just doing good work here. Okay, I don't want to learn about whatever that is. Okay. See, I don't want to learn anything either. I'm just like you guys. All right, anyway, so here we go. Let's do next available for sale short term. It's really easy. Once you see it, you got it made. Dividend, net income, change in market value. What do you think we're going to do with the net income? See if we have no control. No entry. No kidding. That's the same. Right? Of course. What's it going to be on the available for sale long term? No entry on the net income. Sure, I don't have any control. All right, what am I going to do with the dividend? See, as I'm just taking whatever the dividend is. This is unbelievable. I'm going to debit cash. What am I going to credit? Dividend revenue. That's not dividend retainer. It's dividend revenue. You know what dividend retainer exists. Dividend revenue. Good enough. Abbreviations. Tell. Everybody good? It's exactly the same entry. Look at that. Nothing to it. So what's the only one that's going to be different? The market value. And what we're going to do is I'm going to not debit trading security. This is an available for sale short term. So what am I going to debit? That'd be a real good idea. How much? It increased in value from 100,000 to 110 for the 10,000 shares. How about 10,000? Same amount, right? See it? Just different account. And credit what? Unrealized gain on what? Well, no, what do I call these things? Here I call them trading securities. What do I call them down here? Available for sale short term. Got it? Now, what kind of an account is this unrealized gain on available for sale short term? It does not hit the income statement. What is it? That's an other comprehensive income account which goes directly to equity, guys. By the way, does a gain that hits the income statement also go to equity? Sure it does. Where are you going to close it to when you close your books? Retained earnings. So this one's going to end up in retained earnings, right? This one's going to end up in equity. Got it? Directly to equity, other comprehensive income. Okay, one more, and this is even easier. This is unbelievable. Once you've got it made. Here we go. What's that going to look like, you guys? Available for sale, long term. Guess what we do with the dividends? Same. It's the same for trading securities, available for sale short term, available for sale long term. Everybody got it? Guess what I'm going to do with the net income or net loss? No entry. It's the same for all three. Oh, this is too much. So the only thing that's going to be different is the change in market value, okay? Everybody good? So for the change in market value, this time I'm going to debit available for sale what? Long term. That's the only difference. Unbelievable. So it goes from 100 to 110 if they happen to be held for long term, right? And credit what? Unrealized gain. Fantastic.
Is that still another comprehensive income?
Yes, it is. Both available for sale, long term or short term, are other comprehensive income accounts. Unrealized gain on available for sale, long term or short term. So this would be long term. That's $10,000. What kind of an account is this? Equity, right? It's going to go to other comprehensive income, which is an equity account. Does not run through the income statement is the whole point. Right? Beat that to death? John, I'm sorry I kept you over. It's the first time, right? Yeah. Sure. All right, gang. So, how many of you plan to come now for lunch? How many are going to stay for lunch? Raise your hand real high, please. And somebody else count. Would you turn around and count too? Count yourself. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. Did you get 15? Okay, so we're going to tell them 15 folks, okay, plus whoever comes. That's fantastic. Oh, by the way, I'm going to have you go, we're going to go around the room and you guys are going to say your name, what year you are in school, what you're doing, something, just real quick, something about yourself, and that way you get your name and your face to them. First time, right? First interview. Not really. And if they'll ask for questions, ask anything about anything except how much money you're going to make. Ask what you're going to do, what the training's going to be like, what do I get to do, right? Do you travel, how many hours you have to work is fair game. They'll be talking about all that stuff. So write a few questions while they're talking. If you ask a question, it's impressive, right? You got the guts. And you get to the floor, you guys. You don't want them to talk to me, you want them to talk to you. I don't want a job. I don't have one and I don't want one.
So that is, or that's, so we're gonna answer 9:45.
Yeah.
And I feel like I'm, technically, I get double whatever it is for an hour.
Yeah, remind me, and maybe we'll start at 9. I don't care.
I probably won't,
There's a
I
kid
don't
who
feel like I
actually
need
gets
that
double.
much.
There's a kid who gets double, so that's not gonna be maybe we'll start at 9 that day. But then it takes the price off. When you're done, you can take a break and come back for lunch.
Okay.
Or you can start at like 16 whenever you want. You know what I
Well,
mean?
I mean, usually I feel like I take the whole time, but just to demonstrate. Thank you.
There's so much going on the day before and still.
It's not that, although. that happens, you get nice little, so you can back off at the end.
Well,
You know, I always did, so I can really relate to it. You know, I'd be kind of, I actually I'd back up in the middle, and then at the end I'd cram. Horrible way to do it. You can't do that in this program. It won't work. Okay, we'll nail me in between. So you know, you'll be a B minus student, C plus instead of an A minus B plus, and that you won't get a big fortune on. You get a corporate or a large local, which would be fine. But close the doors. Don't close any of them. Okay? Because I can envision you working in any environment. With your personality, you'd be fantastic. Here's the thing. This is a people business. We talked. That was a hard thing for me because I like people. You know, but you know, I mean, you're just talking all the time. But yeah, I felt like I was working from talking to people. That's what you're doing. You're not. You like knowing everything. Oh man, you're so fantastic. You're gonna know all your clients. You're gonna know all my name. You know all the people that work there. You're gonna show up with cookies for people when you come in to do the audit. You are gonna be beloved. But also, I like the substance behind it to manage the proposal if you're scared. It's going to be a partner. Okay? That's all I wanted to tell you. You don't have to do that. You can go any direction you want. If you get this education, you go to work for a nonprofit. Never make any money. You're going to do really good things in the world. Fine.
Can I tell you what I want to do with it?
What?
Start a bakery.
Cool. That's great. So do you want to survive or do you want to go broke?
I'm not doing it love.
No, do you want to survive or do you want to go broke? You don't get to do what you love if you go broke. You won't even love it if you go broke. So do you want to know how to run the business?
yeah.
Do this. Yeah, but get your mindset. You know what? I would go to work for a CPA firm that has bakeries as a client and work there for a while, see how they run the bakery. Does it make any sense? And then I'd start a small bakery. And you're going to be successful in the bakery business. You know why? Because you make fantastic pastries. Okay, so, you know, that's the importance. The product's the important thing. But if you don't charge the right amount for it, you still go broke. I mean, if you don't collect, you still go broke. And you have such a good heart, you're going to be giving them away. And I want you to do that. So when somebody like me comes in, I want you to charge me 5 times what it costs you to make it. So you can give them away to people who can afford it. If you don't charge me 5 times as much and you still give away, you're going to go broke. So you can figure all that out, right? It's no big deal. I'm working with you guys and I'm getting paid for it. And I hope I'm not doing it for the money, you know. But I am kind of. I'd starve. Yes. But you know, I'd retire, I guess. But you don't think about doing it for the money while you're doing the business. But then at the same time, say, well, yeah, but I'm getting paid for that. So Friday, half a day, I'm going again to St. George's to help them with accounting. And I don't get paid, and it's just hilarious. It's just a mess. You know, but they're really nice people, and they really care, and they're really making things happen in the community. And I probably feel better about myself if I did that full time. But, wait a minute. So go away. It wasn't to chew you out, it was more fun time. So, sir, how you doing?
Alright. You did good today? Alright.
Did you like it? Did you enjoy yourself? I'm Keith, by the way.
Shake your hand. Tell me your name again.
Mason. Yeah, Mason. You're a good boy. Sits right down, behaves himself, do some pictures. That's cool. Did you take notes on what I was talking about? Did you understand what I was saying? Good.
What's your bad word?
It's not bad. Yeah. I draw pictures on the board, don't I?
What the guy is flooded?
You really do it? You
That's
erase it?
excellent.
Frankenstein.
Oh, that's so cool. Frankenstein. I like Frankenstein.
With a ghost hand.
With a what?
Ghost hand?
Ghost hand. Oh, cool. That's cool. Yeah. You just keep pounding on it. Study.
Did I get in there?
Yeah.